Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Is TRID slowing you down? Not if you're closing with UWM. While other lenders are struggling, we're closing most TRID loans in 15 days or less, thanks to easy-to-use tools like UClose and Ease, and direct communication from submission to close. Get United at UWM.com.
Welcome to Master of the Markets. I'm Barry Habib at MBS Highway, and this is created exclusively for Mortgage News Network. Brought to you by our friends at United Wholesale Mortgage, who have some great tools for you to use. One that I really like is their income calculator. It's the same calculator that their underwriters look at, so watching the same thing, critically important, and gets you great information back to your borrower and referral source. Excellent tool. Hey, last week was kind of a quiet one for a change. That's a good thing. Not a lot of economic data. We did get CPI showing inflation ticked up just a bit here, and that caused bond prices to weaken a little bit, interest rates to move up just a little bit here. We're in the middle of a wide range now, so we'll have to watch the events of this week, and this week we're going to get predominantly housing data. Now, housing data, very important for what we are looking at overall in the marketplace. And it's always important to get this information in the hands of our borrowers and in the hands of our real estate agents, because they're wondering what's happening here too. The media constantly badmouths the housing market, scares a lot of folks, but I've got to tell you, the information that we are seeing from all over the country suggests to us that we are going to see continued strength in housing. It's almost Goldilocks in all areas. And hey, why not take a look at MBS Highway? You can click on the link and try it for free, or use it if you're a subscriber every day to get this information out. It's extremely vital in times like this, where we're going to have a ton of housing data like we are this week. For example, you could pick any metro area around the country. So just go around to anyone, just randomly pick whatever one you like, or pick one, of course, to your particular marketplace. And if you were to do this and say, okay, for example, I want to take a look at, Salt Lake City, Utah, for example. Let's take a look and see how Salt Lake City looks. Well, currently, affordability, the percentage of households who can afford a home with 5% down, very high, 68%, rivals the best levels ever on record. And you can see it's actually improving through 2015. Now, when the market got in trouble there, only 43% could have afforded a home with 5% down. So it is not a bubble area. And now when we take a look at appreciation, we see a C. Well, C is average, which is okay, but the trend is higher. So it's been keeping pace. It's been about average with the rest of the country. Resale volume also actually slightly below average, but that's a good thing. And that's reflective of a lack of inventory. Media doesn't understand this, but a lack of inventory is very, very good for supporting prices and seeing price increases. New construction, not an oversupply, very slightly outperforming. And here's the other thing I think is really excellent too, is incomes. Boy, this is what I'm seeing as a big plus for the Salt Lake market. Look at the surge in jobs. Now, it's tempered just a bit here, but still a really strong surge in the job market, and that bodes well for real estate. Now, clearly, you can save this as a PDF, fire it out in 2 minutes to your customer so they can see the benefits of this. And this is updated every single month, so the clients will be able to get a report from you and see how their home market is doing before they go ahead and purchase a house. Makes you a great resource. Now, I am concerned about something that we're seeing happening here, and that is what's called the tightening of the yield curve. So what does that mean? So the U.S. Treasury puts out bills, notes, and bonds, and here's the defining factor. If you have an instrument that is less than 1 year or less, it's called a Treasury bill. If it's longer than a year, up to 10 years, it's called a note. Greater than 10 years, it's called a bond. So we look at the 2-year Treasury note and the 10-year Treasury note. Now, the 10-year, we're very familiar with. A lot of people look at that kind of as a proxy to give you a gauge of the direction of mortgage rates. Mortgages are based on mortgage-backed security, and your rate sheet's based on exact trading of mortgage-backed securities. But the 10-year Treasury note gives you a lot of clues, direction, and it's a reasonably good barometer that's kind of easy to see, although it is not exact. Mortgage-backed securities are. But when the 10-year Treasury yield, so in other words, you're giving the government money for 10 years and they're paying you interest. Currently, that interest rate, let's call it roughly 2.25%. The 2-year Treasury note means you're kind of putting money away for 2 years and you're getting interest. logically it should be a lower rate of interest, and it is. It's a little below 1% today. But so the spread between the two is, let's call it 1.25% or so between the two, 1.3% between the two. But when that starts to narrow, where the 10-year Treasury note gets to be a smaller difference from the 2-year, and in fact, at times when it goes inverted, meaning the 2-year Treasury note has a higher yield than the 10-year, doesn't really make logical sense. That's times where people are on high alert for a recession. And recession is not good for homes. It's not good for the stock market. Interest rates tend to remain low, but that's when that 10-year Treasury is so low because people are saying, hey, you know what, I think that there's deflation coming, or I think the economic conditions are not good, and people are parking their money in 10-year Treasuries. I want to show you a chart that's very interesting. Then this chart here can show you that the 10-year Treasury is actually at a lighter spread right now with the 2-year Treasury note that we've seen in quite some time. If we go out a little bit longer than a year ago, that spread was up over 2.5%, 2.57%. Now it's only like 1.35% or so. So a large decline, as you can see. You can see it's even come down from further levels. Now, take a look when it actually got to almost no spread between the two, or when it went inverted. When was that? Well, 2006, 2007. Not a good time for the economy, not a good time for the housing market. So as we're seeing this drop in the yield curve, it gives us a little bit of a reason to be cautious here. Why? Because there's a lot of talk that on December 16th, the Fed may actually consider hiking interest rates. And I think that there's a good possibility that that would happen, perhaps maybe a 60 or 70% chance. Now, if they do, the 2-year Treasury note probably will react most to that, and that 2-year Treasury note yield might rise a little bit. And the 10-year Treasury note, here's the interesting thing. In the past, it's been 9 years since the last Fed rate hike. In the past, when the Fed's hike rates, if it was perceived as a move to kind of curb inflation, the 10-year Treasury note yield actually can move lower. That's good for mortgage rates, certainly, as bond prices would improve. And the other thing is, if the stock market doesn't like it, money will come out of stocks, plow into the bond market, into 10-year Treasury notes as well. And we could see that 10-year Treasury note come down a little bit further. That narrows this already relatively narrow spread between the two. And if it gets under a 1% spread between these two, if there's less than a 1% difference between the 2-year Treasury note and 10-year Treasury note, people will start to use that is recession buzz coming, so that could strike some fear into the markets as well. Just something for you to kind of get a first heads up on and start thinking about as that December 16th Fed meeting approaches. Something to watch for is the narrowing of the yield curve. And hey, get this stuff every day, as I said. Click on the free link. Come on board with MBS Highway. We'll look forward to having you, and see you next week. By the way, happy and healthy Thanksgiving to you and your family. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage.
At UWM, our AEs receive over 500 hours of training each year to keep you current with the industry. We give you direct access to your own team of underwriters who return your calls in 3 hours or less. And we provide exclusive products and tools that give your business a competitive edge. In fact, everything we do at UWM is dedicated to championing your success, which is why more brokers choose UWM than any other lender. World-class service, exclusive products, groundbreaking tools, and you. Get united with us at uwm.com.
This is Mortgage News Network.